So, good evening, everyone, and welcome to today's webinar hosted by Time Health Capital and Dr. Breathe Easy Capital. I'm Dr. George Ozoude, an orthopedic surgeon specializing in sports medicine based out of Houston, Texas, and founder and CEO of Time Health Capital. It's a real estate syndication firm dedicated to helping professionals, especially physicians, achieve financial freedom through strategic real asset investments. In addition to my medical career, I've been an active real asset investor since 2016, building a diverse portfolio across multifamily properties, medical office buildings, agricultural land, and mineral rights within the energy sector. Over the years, I have participated in over 25 investments as a limited partner and have taken a leadership role as a co-general partner in 4 syndications, managing assets worth over $75 million. My mission with Time Health Capital is to educate, empower, and provide access to high-quality investment opportunities that create long-term financial stability for professionals navigating today's medical landscape. I'm excited to have you all here as we explore our topic tonight, which is our year in review for both Bio and I, as we've invested in multiple different assets. So this session is designed to provide valuable insights and actionable strategies. So I encourage you to stay engaged and participate actively, and I'll kick it over to Bio for intro.
Okay, thanks, George. I'm Dr. Fasanya. I'm a pulmonary critical care physician. I'm based in Fort Smith, Arkansas. I also practiced for about 5.5, 6 years until I saw the writing on the wall and got enough passive income to be able to quit my job. I started my private practice. For the past 8 years, I've been doing real estate syndication. I've invested in multiple assets classes, including oil and gas, multifamily, luxury senior living. We have a lot of self-storages also. We have over 184 million under management between the deals that we do ourselves and the one we partner, and over 1,800 multifamily units. So we also buy businesses with the goal of scaling them, stabilizing them, and selling them. So we're still in the middle of that at this point. So today, I wanted to go over the deals we did last year, how they're doing. And then if we have some time after, we can talk about one of our struggling deals and what we learned. We also exited one deal. We can discuss about that too. But all of this is just to show some transparency and also let people understand in real estate syndication or real asset syndication, it's a mixed bag. You win some, you lose some, and some are just in between.
Yeah, absolutely. I think super important to, as they say, post your wins and your losses. And as we're physicians, we know there's no such thing as a doctor with no complications, right? That's a red flag, if anything. It's good to just learn from the challenges, and that's a lot of what the goal is here today. So I'm going to kick it off with Time Health Capital, and then I'll kick it over to Bio, and he'll show you his year in review. So obviously the disclaimers, you can read that. This is not personal investment advice. You definitely need to discuss with the appropriate professionals. So just the intro again, went through that already. So I would like to just talk about the deals that I've exited last year and look at their performance, and then also the deals that we continue to hold and how they performed, not only just in 2024, but since we acquired them. So we'll go through mostly multifamily, but I even want to talk about one of my other real assets, which is the ELA Dennis at the bottom. It's a mineral rights investment. So as far as the exits, I'm happy to say that we finally exited out of Cantera, which was my very first syndication for multifamily, at least, and that was in 2018. We acquired this large multifamily property in the Dallas-Fort Worth area. Very interesting about this property, it was a 6-year hold. Usually they're 4 to 5 year holds. And we only had a 1.3x multiple. So yes, while we made money, and I'm very happy about that, it was actually a much lower multiple than we projected. So that calculated out to be a average annual return of 4.47%. Not great. That you can invest in many other assets and likely do better than 4 to 5% a year, including a lot safer assets for 4 to 5% exactly per year. The good thing about this is was fixed debt, but the really notable thing about this is we started this investment in 2018. Multifamily assets reached their peak valuation in 2021, and we had an opportunity to either sell or refinance. And that's what a lot of properties did at that time. But because we had a fixed debt loan, even though our percentage, our interest rate was low, it came with a prepayment penalty. And that is what discouraged the operators from refinancing at that time, which was, or selling at that time. It's interesting to know that if we did sell at that time, we would have made a 1.8x multiple in 3 years, which is really good for this space. And the projection was at 5 years to make a 2.3x multiple. However, interest rate hikes got in the way of that. This caused a big hit in the valuation, no matter if your deal is doing well or not, no matter if you have fixed rate or variable debt. Once interest rates go up, the next buyer has to either assume that loan or they have to get the new debt at the higher rate. And this took a huge hit on our valuations. We ended up holding without refinancing, and therefore the decision was made to sell this year and at 6 years. And you can see there it's a 1.3x multiple. Not as good as we wanted, but I'm definitely happy we didn't lose any investors' money. And unlike the next deals where we have examples of both loss of some of the original capital and all of the original capital. And these are deals I invested in. You're going to notice a trend here. So again, multifamily, again, DFW area for both. So a lot of apples to apples comparison. But then these were both 2.5 year holds. For Sunset Heights, we only got back about 30 to 35% of our original capital. So we did not make money on this deal. We lost actual investor capital. So 65% loss of the original capital. It was acquired in late 2021. Remember when I said the valuations were high? And so these were expensive properties to buy. And not only were they expensive at that part of the cycle, but they were only being able to be purchased with variable debt. It was very hard to get fixed rate debt at this time period, something that I had not keyed in on. So apples to apples, except for this component. And same thing with the next deal. Also multifamily. In this, the deal was bought in January of 2022. So even after valuation started going up even more. Again, variable rate debt. In this situation, they actually had such a fast, rapid rise of their interest rates, and they became so burdened with the debt service that they actually made not one, but two capital calls. So the deal struggled a lot as opposed to Sunset Heights, where there was no capital call that was needed. It was at least purchased at a lower cost basis, meaning price per door, such that they just had trouble holding the deal. They didn't necessarily have to get a capital call earlier on in the deal. Unfortunately, luckily, I didn't participate in that capital call, but I know others who did, and it went on to completely be valued underneath the remainder of the loan. And the decision was made because there was no runway, there was no clear path to getting this back up to a good valuation for either a refinance or a sale. The decision was made to sell it at a loss. And so all investor equity, the original equity, was wiped out. They're saying maybe some of the capital call can be returned. I wouldn't know. I won't know those details. I hope some of those investors' capitals get returned, especially for the capital calls. So there was another point I wanted to make, and I forgot. But the headwinds, and I look back and see where we went wrong. Oh, the point I wanted to make, each of these three properties had performing assets, meaning the actual property was performing well. We had occupancy between high 80s and low 90%, and some even at times were 95%. So the fundamentals were fine. It's the capital stack and the debt structure that had all the headwinds. And so that's where things went awry. which is important because it's not just about collecting rents and filling the units. It's also about how the capital stack and the debt structure is organized. So those were headwinds. Those were exits from last year. Some holds, some more positive news. We had a great year and past 2 years with the Derby. That's a multifamily here in Houston Metro. We acquired it in February of 2023, so it's been 2 years. And within 4 months of acquiring it, we've been able to make 6.5% cash on cash distributions averaged out over every month. Those were monthly distributions. We acquired it with very low agency debt. So at this point, 2023, people saw the writing on the wall and they moved away from variable debt. And I think that's real prudent. And so this has been a great success thus far. Land bank lofts, multifamily in South Carolina, purchased, acquired in January 2022, 6.9% cash on cash return, also fixed debt. And I love that the fact that these guys saw the importance of getting fixed rate debt, even at a time when there was a lot of variable rate debt in January of 2022. Another huge component of this is there is a tax abatement because this used to be a old financial firm for farmers. That's where the term land bank is from. It's a federal land bank. It used to be, and it was converted into apartment buildings. And so by preserving the historical building, you get all these tax credits. And I definitely think that helped with controlling expenses, especially over the last 2 years. A lot of properties have seen increases in insurance premiums and in property taxes, which put a lot of stress on the financial stability of the property. I also invested into mineral rights, which is a type of oil and gas investment. I'm happy to talk about that with anybody if they're curious, because I know it's not quite as well known as either multifamily or even oil and gas working interest investments. But acquired this through a syndication in 2022. So it's been 2.5 years. They started making distributions in November of that same year. They started off really hot because the price of oil was very high. And so this is related to, just like an oil and gas deal, where the price per barrel is. As that trended down and the price per barrel started to decrease, it has tapered off. But for year one, it was closer to 20% average annual return. And now it's averaged out over the 2.5 years to about 9% to date. This is located in the Oklahoma Anadarko Basin, and I've been fairly happy with that deal. I'm very optimistic about it because I do think the price of oil will go up in the future. And I do think that this number will increase significantly. Of note, this is different than a multifamily or real estate residential investment because there's no equity, quote unquote. This is a sunken cost that you initially invest, just like an oil and gas deal. And now the clock is just ticking until how soon can you get a break-even point and get return of that capital and then continue to cash flow beyond then, where it's just what they call icing on the cake. So right now at about 9% average annual return, if it stayed like this, it would take 11 years. But like I said, I think it's going to increase as the price per barrel increases over the next few years. And I think that it'll reach that break even a lot sooner. So lessons learned before I kick it to bio, based on my experience, I say fixed rate debt always, almost always. I think it just allows for a lot of more wiggle room, a lot more predictability. Yes, there's a prepayment penalty, which could impact the returns, which you saw in the first case. But even with those prepayment penalties, we could have exited that deal at year 3 at 1.8x multiple. To me, I'll be happy to pay the prepayment penalty if we can get out in 3 years at 1.8x versus waiting another 3 years and now it's unpredictable and now you're dealing with a lower equity multiple. And I will say occasionally variable or variable rate debt is okay, but I think it's very specific circumstances. Everything has to line up. There has to be a clear path to rates going down and the opportunity to refinance multiple times as you follow the rate cuts. So maybe now, some people might argue, is a good time to consider it. Some people maybe early last year was saying a variable rate loan is a good time. but you have to be careful because anyone who bought with variable rate loan early last year, they're now seeing interest rates from the Federal Reserve pause, the interest rate cuts pause. And you're also seeing the bond rates increase, and therefore mortgage rates are going to follow the bond rates. And it's a good in theory, but you can always face some kind of black swan event or economic circumstances where the interest rates have to go up. And now your plan is in jeopardy, your business plan. So I think
I
it
was
has to
gonna
be
say that.
a very clear. Yeah, go for it, Bio. Yeah.
Sorry, yeah, but yeah, for example, we do invest in Canada too. Canada is definitely cutting, probably faster. They try to protect the real estate market better than the US market, in my opinion. But then just right as I signed the variable rate, like literally like before Trump came in, and then there's the tariffs and all those things could have just killed it.
Black,
So I was
Black
like,
Swan.
oh, so yeah, I think for you to be able to do your assessment, be able to plan properly, to be like, no matter what happened, you're able to maneuver yourself. Fixed. To be able to do variable, you're making a bet for sure.
Yep, it's a bet.
It's a bet. You're betting. So it's a risk you're willing to take. But I thought for Canada for sure, I was like, man, the rate is gonna be dropping. It's gonna drop, I think. But hey,
I think so too. Yeah,
it's a risk. And also this one is a smaller thing that I feel like worst case scenario, I'll be able to carry it.
you'll be able to absorb it if it does
Absorb it. Yeah.
go the other way. Yeah. I say maintain more cash reserves. Make sure you raise enough capital or you have enough capital to have reserves in case expenses go up like they have. And that hurt a lot of investments, including some of the ones that I was in. With the interest rates hike and inflation at the same time, that affected everybody, even the property or even the insurance companies and the maintenance people. So everyone's prices went up, and therefore the expenses in these multifamily investments went up much higher than people expected. So maintaining more cash reserves, being more cautious with how much distributions you're making. If it's cutting too much into the cash reserves, you have to be aware of that. Maybe it's necessary to raise more money than you think you need. Check if the operators are considering that if you're an LP, you want to have that conversation or ask those questions. How much money you guys going to hold? And then buy the biggest discount possible. And that's also related to having cash on hand, because the cheaper you can buy the deal, the more wiggle room you have. You can get more debt, or your debt ratio can be a little bit better. You can raise more capital. If you have your capital raising capacity is only 2 million, that limits you to a certain deal. If you can get that deal cheaper, then you can raise that same 2 million for a cheaper deal. Therefore, more cash reserves, more resilience. And so I think those are the big things that I've learned from the past few years, and especially this past year as those deals exited, taught me a lesson. The outlook this year, multifamily, I'm still very interested and bullish on it, especially this Class A space, anything built after 2000, because I think the deals that you saw that I exited, those were discounted deals. They were discounted deals for the next buyer. Somebody got those deals at excellent cost basis, at excellent price per door, because we had to sell for a loss. They're going to do great. They're going to cash flow from day one. They buy it at a discount. And I think if you buy them a little later for like Class A, like 2000 or later, now you can plan to hold them for a longer term and just cash flow off of them. You don't have to worry about exiting the deal in 2 years or 3 years and just being transactional. You can actually cash out, refinance, and run the infinite return business plan. And you grow your portfolio, take that cash and go buy another property, but still hold on to the cash flow. You still own the cash flow. I like the industrial space. I've been looking around Texas, driving all over with my truck, just going to see all these like boring looking industrial spaces. And I think those are very in sustained demand right now. They cash flow from day one. If they have a tenant, you can do triple net lease, which takes some burden and risk off the operator and investor, since the tenants are paying everything, almost everything. And then small businesses, there's just a wave of baby boomers who are retiring, and they want to get out of their very profitable, stable, cash flowing businesses and they're willing to even do seller financing and stick with you a couple of years while it transitions to the new ownership, which is huge. There's some very, interesting stats about how many of these baby boomers are retiring and they have no one to sell it to. There's no one, there's no kids that they there's no buyers. They're in rural areas or something like that, but they have great businesses. It's definitely a huge wealth transfer opportunity for investors right now. And that's it. I will stop my share screen. Before we switch over, any questions, you can leave them in the chat, or happy to raise hand. If you raise hand, we're happy to call you up and answer any questions about that.
I definitely like your input because you do a lot of limited partners far more than I did. So you're coming up from that perspective where you
Right.
have so many mixed and so many deals. You have over what? I mean, 27
Yep, 26
investment,
now, counting.
26. So you
Mhm.
invested so much. So there definitely will be mixed bags for all of them. Also, those are some of the ones that you did in the beginning as you're learning along
Right.
the way.
Yep.
So I wonder if we could do something along that way. 5 years ago, 4 years ago,
Oh
3 years
yeah.
now, are we actually got smarter?
Oh yeah. I think
Over
so. I think
time.
if you track it over time, you'll see the investment pattern changes, what you look at changes. And one big thing is I thought I was super patient to begin with, but now I'm even more patient. You just wait
Same
for the
thing.
right deal.
Yeah, we do less deals now per year.
Yeah.
While we're waiting for questions, I'm going to come from a different angle. So let me start.
No worries. I see a
So
question from Carl real quick before you start.
good.
How did you decide where to purchase your mineral rights? Did you feel mineral rights is better than investing in a group of wells where you potentially get more tax advantages? Yes, and I've gone back and forth a lot about whether I should invest in mineral rights alone or do a little mix of mineral rights and oil and gas, which is working interest when you talk about the wells. And Bio can jump in too because he actually is on the other side. He invests in the wells. It's risk for me. Mineral rights owners get paid first. They automatically get a royalty out of what on whatever comes out of the ground. That oil and gas company that's drilling and digging, they could pull out water, they can pull out oil, they can pull out diamonds. Whatever comes out, usually around 25% royalty goes immediately. First, they're the first to get paid in the capital stack, goes to the mineral rights owners. So I like that aspect of the risk mitigation. So whether they find oil or not my concern, whether they're trustworthy or not my concern. And that's one of the big things. Location wise, yes, that also matters. You want to pick areas that are known to have oil. And that's why I put up there, this was in Oklahoma in the Anadarko Basin. There's many different areas in the US that are just known to be oil rich. And that's where you're going to find the oil and gas companies targeting their businesses. And so, yeah, I still am not completely opposed to oil and gas because you're right, with mineral rights, you do not get any tax advantages. And I know that's big for high income earners. But to me, the risk was a little too high for me at that time. I definitely can change my mind over if I get to know operators real well. I've gone and visited headquarters of different oil and gas companies to make sure I can touch their building. Next thing I want to touch their drills. I'm going to make sure they got the equipment. It's just a matter of being comfortable with the operator, which is always the number one risk is who's the operator. With mineral rights, it's the same thing. You have operators who put together the deal, and you have to trust and vet them for as well too. So I think it's just a little more risky on the working interest side.
Yes. There's
Yep.
no gain without some risk. Yeah, you definitely have to decide what are because I think mineral rights, right? I don't really see that kind of 3x,
Right.
4x return. But in oil and gas, I've seen it. However, it's far and in between sometimes. It's just about where do you want your diet? Why is your diet? There'll be more risk, more return. So I make a decision. Same reason why you do development versus light value add,
Yep.
or you do business that just getting started. versus business that's already stable. So you decide your risk.
Yeah, that's a great way to put it. And it's a portfolio, so you can mix it. It's not like you're can't team mineral rights and you can't come to the oil and gas party anymore. You can mix. I'm gonna jump to Deidre's question because it's a follow-up. Can you describe mineral rights? Yeah, so mineral rights is a concept that there's actually surface real estate, and then there's everything from underneath the surface is like a certain amount of feet. Let's just say 200 feet. I don't know if that's exactly it. I have to double check. But everything 200 feet and below is mineral rights. So when you and I own a house, we only own the surface rights of that land. We actually don't own what's deep down in there. So any of the value of stuff down there from 200 feet down to the core is actually a whole nother set of owners. It's crazy. And a lot of times the surface right owners are the same as the mineral rights owners, but they can be different. And so mineral rights is ownership of whatever is deep underneath the surface. I don't know if that fully explains it or not. There's also air rights, I think. So there's a different set of air rights. There's water rights. So if there's an aquifer somewhere, somebody can own the rights to the water. That's actually probably a pretty good investment idea going forward. And the water shortage is coming for sure. But yeah.
Interesting. So how do I, how do you get maybe that'll be a different lecture. I'd like to know more though. I know
Yeah.
oil and gas, but I don't actually know too much about the mineral rights part of it.
Yeah, we're gonna try to source some mineral rights operators and bring them on for sure. I'll talk to the ones who I work with, and there's many other outfits out there. So,
Okay. Awesome. Okay.
and then Ryan had a question. How do you approach staggering or balancing investments across short, medium, and long-term risks or long-term exits to optimize risk, returns, and liquidity? Any general strategies or insights you follow?
I'll start.
Okay.
I'll say for me, I first of all have my personal financial kind of statement or plan in which I know I said I want to be about 50% in real estate, about 30% in stock, 10% in business or 15%, and then 5% in asymmetric upside play. So that's where I put my crypto, somebody do a startup. So you want to start first to see broad, what kind of asset class. If you want to run 100% real estate, then you say, okay, fine, 100% real estate. Now, out of those real estate, what are your goals? Do you care about income? Personally, right now, I moved away from just income only, mostly for me, equity, more of improving my net worth because I have a private practice now and I have other already passive income enough. Now I'm focused more on equity and things like that. You can see me doing more development and things like that personally. It doesn't mean I will bring it to syndication. So I think you have to do with your plan. What are you trying to do? Also, if you're trying to replace your income, then you need cash flowing property. And also depend on the stage of life, in my opinion, too. For me, I'm 38. So right now, at 38, and I've got to where I am now, I felt like I can take a lot more risk. I would then allocate more into higher risk assets that will produce maybe higher return versus if you're like in your late 50s, you might want to go for those class A that George talks about, where they get like 5%. And that might be a long-term one where 20 years, very stable. So that's kind of the way I see it.
Yeah, well said. Nothing to add.
Okay, so mine is going to be quick because for me, I'm just focusing on the two deals we did last year. Now that George mentioned the mineral rights, I remember that we actually did oil and gas just like December. So I did a webinar like literally December first week or so. So not enough time to actually get a lot of momentum before the end of the year, but we continue to raise into the deal. Like I said, I'm a pulmonary critical care physician. I own my own private practice now. I do have a blog and also run Dr. Capital. I have a car audio company, a DME company, and some tiny little smaller companies where I'm just a particular percentage, but these are major ones in which I actually do own 30, sometimes 100% ownership. About a decade experience at this point between investing as a limited partner and then general partner. We also have a manager now, but Josh is our acquisition manager. Richard is our business analyst, and I have my executive assistant right now. And we have Melanie, who is our manager. So we're going to talk about deals for last year. Those are good. So we start with that. We talk about an exit, which is borderline. We have one struggling deal. We just go over it a little bit just to talk about what are the things that we faced in the deal and also the lessons that we learned. Most of it George already mentioned, but we're both in this deal, George and I, so we can just go over what we both learned in it. Same thing, we have a disclaimer. So the first one was the Ridley Home, which is a partner with the Disrupt Equity, and George played a major role in this particular one. So we went there individual different times, but it was fun. So it was a 405 units, is in Houston. We closed in June last year, which means for the first 6 months, we didn't do any deal. That's one of those things about being more patient now, based on the economy, the way things were going. So unless the deal really makes sense, and this deal was got at a discount, right? Is it not like 30%, George?
Yep, over 30% discount.
Yeah, it was like a same discount. So as a result, despite the occupancy being like in the 80s, it's still cash flowing.
Yep.
So and then also we had an agency loan. Same
Right.
thing with like in the fives. I think it's like 5.0, 5.1, very
Yep.
low overall. And that was when the interest rate was like 8%. With having those combination, it allows distribution to start like November. So that's just something to think about. We're going to talk about that. This is a primary market, Houston versus Fort Smith, Arkansas, right? So that's one of those things that, when the economy is struggling, it's probably better to stick with the bigger market, places that are more resilient. Okay. So we got the other one, the Candle Ridge. So now that I found out about Houston, I'm not leaving now. So we got another one over there. It's 128 units, Candle Ridge apartments. These are my partners, Wayne. And so same thing in Houston. We closed August. And then by December, same thing here. We're already distributing. And so I'm going to go over one of the reasons why I feel like those two were successful. Of course, the ones many years before, many of them are called GP on. I do not have any capital call currently. Interesting enough, in all my deals, at least even the one that I partner in. There's one that was standing, we're not sure. That was one of my first investments in 4 or 5 years ago. But I didn't do a lot of limited partner deals. Most of my deals, I was a general partner. This one, we have such high hopes for this particular deal. These are luxury senior living. We started thinking about the deal in 2019, eventually came raised for it, got everything, all permits, everything done by around April 2022. It was 2 luxury senior living in one of them in Wentzville and one of them in O'Fallon. Is by St. Louis. It's close to St. Louis. The first one, both of them supposed to be built like 2 years. But then there was like a lot of delay. So that was the main issue with this one. To the remnant of the COVID, caused so much delay getting parts, getting labor. So one of them finally got completed. And then there was an email sent out to investors and everybody what they want to do. So majority, almost everybody wanted to leave the deal. One of them was exited. So that one that was built instead of the 2. And the other one is still being completed, but there was a hold on it. So eventually we got about 24, 25% over the 2 years-ish, right? So that was underperformed because the promise was close to 20% every year, right? Return. Or there was an option to roll it into 12% income fund, which is this is my mentor was the sponsor on this deal, but I was part of the GP, Majestic Investment Group. He actually had an income fund. So most people end up rolling that money into that fund, and then he gives 1% every month. If you're invested, I think I had invested 100K myself, and then I got 125K back, and then now I get a $1,250 every month. Hey, so it was okay. I won't say it was phenomenal. So that's the only exit we have last year. So before we talk about this, we also started the oil and gas. We do have webinars on YouTube on how oil and gas have performed over time for us. We had 2019, 2020, where we got like 20% return, very great. Then 2021, but by the time it got to 2023, it was like down to about 5, and it picked up a little bit last year, maybe about 8%. So oil and gas, it's nuanced. So if you get into it when it was like that, 3, 4, I think it might even be 4%, very low for that year. You might be like, oh, this is very bad. And then the next year you barely eat and hate. And then you don't know whether we're going to exit or what's going to go on with the oil in the world. You know, it's going to stop giving us, shut off the lights, or is America going to start producing more oil? So it's dependent on price of oil, your return. So when the oil was $100, I think it was 120 at one point.
Yeah, it was 120.
Yeah, we were raking in money. I was seeing those distribution every month. I was like, yeah. but now, so we got spoiled the first few years. But I continue to do that because of 100% depreciation in any income, right? So the income does not have to be passive, active, passive. You can deduct against it. So that's one of the reasons why I like the oil and gas parts. But definitely the point on mineral rights, definitely taken. Yes. Sometimes in this deal, when they do the meeting, yes, sometimes I feel upset because they will be like, oh, we make $100 million and then we have given everything to the mineral rights people. But the first that get paid, and they're like, okay, now we have the remaining, and this is what we can distribute to risk. I have some YouTube about the actual, I was actually happy with I'll play it later, with how it came out, the senior living itself. I'll play it later. Any questions until now? Then I will go into the one that we're struggling with currently and what we're doing and what we learn. So we have, this one is local deal in Fort Smith, Arkansas. It's 129 units. We closed it in April 2023. So it's going to be almost 2 years now. And basically, we still have not done any like capital call or anything like that, but I will say that it's been a roller coaster, probably the most complicated deal so far. When we got this, occupancy was great. I think it was like 94, 95. And the first thing we do in almost every single deal I've done, we write a letter. And this letter is this new sheriff in town letter. So you say, look, this is new management, we're taking over. From now, you pay your money on your first 3 days of the month. On the 15th day, if you don't pay, we're going to start the eviction process. But this is a Class C property, like Class C, maybe even a Class C minus, trying to reposition it into maybe a C plus or a B minus. These kind of tenants, interesting. So immediately, about 35 of them left. That is in contrast to the one in Candle Ridge. That was a Class B property in Houston. And we did the same letter, and literally almost nobody left. So it's just, I'm not sure whether they don't like the tone, the kind of people, but many of them are used to paying half, having a payment plan, things like that. So anyway, so that was the first challenge. But at that time,
If I
it wasn't,
if I
go
remember
ahead.
correctly, also Candle Ridge is very supply constraint. Like the location of it, there's like almost nothing else around there. So if they're moving, they got to move to another neighborhood or another part
True.
of the city.
Yeah, true. Absolutely. There is, yeah, over here they can go rent a house, share, and also it's a small town. They can live with their cousin in the meantime. So after that, we said, okay, that's fine, because we were going to renovate almost all the units anyways. So we're like, we're going to renovate it. So we started the renovations. Of course, we got some constraints with the contractors also. Contractors were like, we're going to deliver the 10 every month. So they end up delivering like 6. And then we have a management team at first also, who is basically not being aggressive. So we actually move management in-house for this deal. So that increased the kind of improve the operations for us a little bit. We have more transparency, but it's a lot more work. Then when we're about to start recovering from that, when we started getting our own contractor, then we had fire burn down 4 of the units. That did not only cause, it's not just about the fire alone. Okay, every place was boarded up. It's basically messed up our curb appeal also, so that we're not getting people coming in anymore for a while. People had to redirect themselves to come and see the property because the whole place was locked down. So it was the front facing part of the building too. But of course, we have insurance, and then that one, we only finally got it restored after a year later with insurance. So that's one of those two. Then with the renovation, we have bank. The bank, there are multiple banks I've worked with in the past, and this one, my partner, I've worked with them, but I personally have not. But they offered us a lower interest rate, about 0.3 or so less. So we went with them instead. So since that time, we've had challenges of, so basically when we raised money, so we have funds from the bank, right? We have funds from the bank to do the renovations. So we had the money set up by the bank, but then the bank, because they saw the way the asset was performing, they refused to actually release some of the funds. So then we decided to use some of our reserve to do some of the innovations, because we have to at least get people in there. So we started doing that. And of course, we got low enough, then we have to stop. So then we have to make another deal with the bank to allow us access to that money, which I thought it was a little bit strange that we have to spend so much effort. So it took a while before we finally able to get that money to finally, start the renovation. So now we're back doing all the renovation, doing all that. We got money back from the insurance, and still doing all that. So now distribution is still pending. It's been 2 years-ish currently. And so, so that's just one thing. So I think somebody raised their hands. Go ahead.
Hi, this is Ida again. Sorry, you may have been about to get into this, but first of all, thank you both for your transparency with everything that you're talking about in terms of some of the wins and losses. I guess with Southbrook, one of my questions is what about the property kind of attracted you to it in the first place in terms of opportunity, especially obviously there were a lot of unforeseen issues that came up, but especially with it being a Class C property.
Number one, yeah, I actually forgot to say that. Thank you. So this property, we got it at a very good discount. So that's one thing. And we still think that's one of the things that give us so much confidence. So we bought it at 5.3.
Yeah.
Uh,
5.3.
Yeah, 5.3 or so mil.
Mhm.
So low. And when we appraised it, provided that we give them all our renovation plan and everything, it was appraised for 11.7. It was appraised at almost $10 million. At that time, we're like, man, also in this area, we actually do believe that it could be improved and also be able to increase, like change the culture of the area and be able to move it to like maybe a C plus, B minus, increase. The rent was so low. Right now we're getting rent of $700 for 2-bedroom, 1 bath. Before when we got it was like $400. So there's so much room to grow, but it's a lot of work you have to do to get there. We know that, we knew that, but if you ask me, we will get it to the finish line because we have so much delta in it, so that as long as we're able to do the renovations, get the income to close to what it's supposed to be, and we're able to sell it even at $7 million. We raised only $2 million for this deal. We will be able to double the money. So you don't need. So we felt, man, this is our chance to triple, 3x our money. So that was the challenge. And also in my area, there was some there was some stimulus for growth here. There was an air base in my area, which they're bringing thousands of people into that area, very local area for military purpose. And there's literally no rent, no place to rent, sorry. So the data was very great for when we did our due diligence. And also it was such a discount, but it was a deep value add. It was a deep value add.
Yeah,
just for this kind of deal, you just have to know that it's going to be a lot of work. I don't know if I answer your questions.
I'll also
Yeah,
add.
you did. That's perfect. Thank you.
Yeah, I'll also add some things that I've noted from the ownership side of this. The the speed at which we wanted to renovate. The business plan is to renovate a deep value add. The speed at which we wanted to renovate out the gate was probably too aggressive. Even though we had all those move outs, it was almost like, all right, let's quickly turn these units, get them upgraded, and then rent them out. Probably would have been better to just fill those units as is, cash flow, keep the cash flow high. And then as people slowly move out, you renovate units as they become available. Some people are proponents of just like getting the occupancy really low and renovating as many units as possible, but then it's a race against the clock and you have to get all those renovated units back online. Others are more the opposite, where it's, look, if you're at 90%, just leave it at 90% occupancy. If one or two move out a month, then you can renovate. And I think that more conservative approach with such a kind of particular demographic for Class C is probably a better approach. So that I would say. And then there was things that I'm just learning with the bank. It was amazing to learn that their reserves don't count for the repairs versus the actual upgraded renovations. And that's a lot of what we encountered as well, as far as why it was such a challenge to get the bank to distribute the money that is there for that reason. So they look at that differently. And I think that was a eye opener to show the bank the repairs that we paid for and we need to get reimbursed from them, but they're blocking us from that capital. So that was, I thought, very eye opening and interesting to learn that specific detail about how the banks work.
Yeah, that was first time. I've renovated a lot. My properties I've renovated. We have so many units. This is the first time I've personally experienced it, and also got that lesson of always go with a bank that they're good for it. They want you drink beer. I drink beer with the president of the other bank. So probably maybe a better one that will be able to work things out over a drink versus a whole separate one because they were a little bit cheaper. And I've done this also for contractors in the past. I guess I did not learn my lesson where I was like, oh, I'll go for cheaper. And for some reason, you always somehow. So you just go for what is sure, even if it's slightly more expensive. I would say one personal one that I learned overall, relationship matters a lot with banks. It doesn't matter whether you have a million unit. If they have not done units with you, they will consider you almost like a new person. So they would, everything, they have to be a meeting. We have to make the meetings, we're gonna have to vote on it. It's just, and you're like, man, this is like a month. So anyways, so I'll do quickly what happened with the bank, quickly, 1 minute, because I know people probably still don't understand it. So in the draw, in the bank, they wrote, we said we spent $8,000 to renovate 8 units. And then there are specific things that is written there when we went to do the assessment. They say, okay, we're going to fix the bathroom, we're going to fix the floor, painting, HTC. So now let's say you go into that particular apartment and you end up spending $6,000 doing what was written on the paper. But then when you open the bathroom, the tile, you find mold. But now we spent $2,000 remediating the mold. It still end up as $8,000 total. And to me, in my mind, ask the bank, give us the $8,000, and it's still $8,000. But instead, they will pay for the $6,000. So these are the things that are outlined. Mold is considered a repair, not a renovation. And then they pay you $6,000. So over time, you chip away at the reserve because we paid from that to do the renovation then, to do that part of it. That's what happened with the bank. I don't know. Obviously, we still have to take responsibility no matter what the situation. But anyway, that's what happened there. The lessons, like we talk about, Class C, management challenges. It's not the only deal that we have to change management team. We have one also in the Northwest Arkansas, 376 units. We changed management from the same management team that we took this from. So the issue with that is because you're one of their 30,000 units that they're managing. I tend to go for more of moderately large management team now. So not going to go for some large one like 50,000 units. They will run everything. You don't even know who you're talking to. It's just difficult to get things done. If I have a local management team that even though they have only 1,000 units, I'll probably use them rather than use those known management team. They don't also understand this area as much as you would think. Yeah, so that's what it is. Bank, also primary versus tertiary market. When I still think it's okay. And also Class C, that's why George is probably mentioning Class A also. I think we're taking a break. So now we do B. Probably not all the way A for me, because I feel like there's not a lot of margin to make money in many of the Class A. But B, stick with B, maybe B minus, so that the kind of people you deal with is also, they don't skip. Skipping is one issue with tenants. They just skip, you just can't find them. So it's quite interesting. But but overall, I would say, also when you get a good deal, there's also a reason why you get that good deal. People have looked at it, they say, you know what, this is going to be a lot of work to turn over. While it's still good, but you just have to be the right person to do it. Also, if you are experienced, it's going to take a while. Right now, we're fine. The only problem is that we're not distributing, but we promise we're going to distribute in 9 months, right? So if you already know, and you said, guys, this might not be distributed in a couple of years or 3 years, but it's appraised very high, we're going to make a lot of money. But don't expect it's going to take a longer time to reach. So that might still work. It's just something to just temper your expectations. So that's about it. Any more to add to that, George?
No, I think we covered a good amount. I know we're 10 minutes past, so definitely want to be respectful of everyone's time, but still we're here to answer questions. If anyone has any burning questions left, we wanted to talk about tariffs and stuff like that, but we can save it
Some other time.
for another
That's
time.
a whole kind of warm.
My short and quick is inflation is coming, so you want to position yourself to buy assets that will hedge inflation or even thrive in inflation.
Yeah.
But yeah,
Picking on that for Canada, I know Canada tried to save the real estate sector is such a big part of Canadian economy. If the tariff has gone through, and even if everything fall apart, in the past, they will always save that real estate market. Real estate market in Canada was on a bubble for 20 years or more, even 30. It was just keep going. I will say same thing. I just told my mom to buy more real estate. That's what it is.
agreed.
Yeah.
All right. Thank you guys. We appreciate the attendance, and we look forward to seeing you guys again in 2 weeks. We'll have our next webinar. We'll bring on a special guest. So thank you all.
Thanks, everyone. Take care.